have been receiving a lot of questions lately regarding the possibilities of residing in Switzerland. Switzerland is not cheap, but it has its supporters for two reasons. There is no capital gains tax there, and additionally, one can take advantage of the flat tax, known as lump sum. With some of you, we have come to the conclusion that this is a good place to live if you have established a private foundation in Poland. Hello. If you are wondering how to safely move abroad, you are in the right place. Since the beginning of this year, nearly 500 people have approached me for assistance with relocating or moving their business abroad. On my channel, Wealth Advisor Anna Maria Panasiuk, you will learn how to prepare for such a process, what to watch out for, and how to avoid unnecessary costs associated with such a move. Subscribe to my channel and stay updated. Let us recall what the tax relief looks like in Switzerland, namely the lump sum flat tax. We talked about this about a year ago. If you come to Switzerland, you can obtain tax residency after just 90 days. You can only benefit from the lump sum regime if you have not been a resident of Switzerland before, or after at least a 10-year absence from the country, and if during those 10 years you did not take up employment in Switzerland. The right to flat taxation expires when you take up employment in Switzerland. This is an extremely important criterion, as it applies to both spouses. As my client recently said, you need to be aware that by using the lump sum system in Switzerland, you will be able to drink rosé wine all day, but you will not be allowed to take up work there. You may also lose the right to flat taxation if you obtain Swiss citizenship. Once the decision is made to switch to regular taxation, it is not possible to return to flat taxation. How is the flat tax calculated in Switzerland? You estimate the flat tax during discussions with the local tax office. This takes the form of negotiations, in which local agents assist. There are legally established minimums that determine the level of this tax. It depends on your wealth or family status. For example, the property you rent in Switzerland affects its amount, as it cannot be lower than 7 times the annual rental value of the house you reside in. Each canton annually publishes the minimum taxable base for income tax, which also serves as a benchmark for the paid flat tax. For example, in Ticino, the minimum taxable base currently amounts to 400,000 francs. Such a minimum base includes both the taxpayer, their spouse, and children under the age of 18. Based on this established basis, the amount of tax for the given tax year is determined. Unlike in Italy, there is one tax amount for you and for family members. Here is one for the whole family. Both the husband and wife must be taxed in the same way, as spouses are treated as a single taxpayer in Switzerland. And where does that amount come from? Flat rate taxation in Switzerland is based on the living costs incurred by you and by all the individuals dependent on you who reside in Switzerland. This means that all hypothetical living costs are taken into account, regardless of whether they were incurred in Switzerland or abroad. And they are treated as the basis for income tax assessment, already according to the normal rates. In practice, instead of living costs, the flat rate amount is negotiated based on income and assets. The negotiated flat rate amount serves as the basis for taxation for both income and wealth purposes at the federal, cantonal, and municipal levels. If the negotiated amount is lower than the minimum amount set by law, it is automatically adjusted to that higher amount. In summary, to estimate the amount of your tax in Switzerland, you need to have the following amount. The minimum flat rate amount established by the law of a specific canton, for example in Ticino, is 400,000 francs, which is equal to 7 times the value of the rent of the house or apartment in which you live. And thirdly, the negotiated flat rate amount that approximately reflects your living costs. And the highest amount of these 3 amounts will be considered as the basis for income tax assessment. At this point, you will not be entitled to any deductions. The tax office in Switzerland is still verifying whether such an amount will actually be taxed at the flat rate tax. Check the income you earn in Switzerland, as the flat rate tax may not be lower than the tax due under normal rules for income earned in Switzerland. If you pass this test, you will know what tax you will be paying. And here's a note. Sometimes we forget, when moving to Switzerland, that our money is already there. They can influence the value of assets and the income earned in Switzerland. When is residency in Switzerland beneficial? When you are looking for protection for yourself and your assets due to geopolitical risks, and you are not yet decided on where you want to live. The education and healthcare systems in Switzerland are very high quality. Switzerland does not verify where you actually arrive. It is important that you do not stay in another country long enough to acquire another tax residency there. Switzerland may also be suitable for individuals who are considering establishing the Polish Family Foundation, but are unlikely to want to reside permanently in Poland. Regulations in many countries result in very high income tax on distributions from family foundations. In Switzerland, if you manage your affairs well, you can handle it appropriately. That's all for today. I invite you to the next episode very soon.